Heightened US-China tensions, tighter monetary policy and a maturing global cycle has all contributed to a turbulent 2018 on the markets, with most major equity markets down on the year. So should investors expect more of the same in 2019? Well, joining us now from Octopus Investments is Investment Director Oliver Wallin. Thanks so much for joining us. Can we expect more of the same?
Well, I think that things are very, very finely poised at the moment in markets, and you've listed off a whole load of factors that are weighing heavy on market sentiment at the moment. None of these factors have gone away, so we are looking at 2019 with the same kind of spectres of binary geopolitical risk and tightening monetary policy in the US. But I think it's important now, as an investor, not to spend too much time focused on the downside risks. They're definitely there, but there is some upside potential as well, and it's just a question of not leaving the market too early, but also not trying to get caught out. So there is going to be some timing issues for 2019.
I mean, timing, as you say, will be key, but in everything I mentioned, and there's a lot more as well out there when it comes to geopolitical events and what's happening in terms of binary, when investors are looking at where to put their money, where should they be looking? I mean, I would know, as you said, we can't say what the risks are, you know, what's the outcome of some of those risks going to be, but is there a way we should be looking at how to invest regionally?
Well, I think that there are, the first question for equity investors to talk about is how much risk they're going to put on the table first and foremost. It's probably going to be the key decision for 2019. The next decision they've got to look at is where they're going to allocate regionally, and you'll probably be looking at the IMF's Global Growth Report to give you some idea of what areas are most vulnerable or what areas could be most rewarded. And then beyond that, it's about positioning yourself for the eventual slowdown, you know, positioning where you are in the investment cycle and what you're going to do about it when you transition into the slowdown phase. Now, on each of those levels, we talked about there being some upside risks. So from our perspective, we still want to participate in equities for next year. We do think there is some upside potential if some of the geopolitical risks go away, and there is a potential for them to do so. On a regional basis, I think it's probably too early to call an end to the US S&P 500's run, and that is because monetary policy is still kind of loose out there, and fiscal stimulus is still at play, and the economy is going great guns. And you know, then we'd be looking to areas where we think that have been hit hardest in recent months, and so global emerging markets, Japan, that have had problems around fears around trade wars, strengthening US dollar, they're all gear played on global growth, and they've been hit hard. There's some upside relative potential there. Where we'd probably be looking to avoid is UK and Europe at the moment. Because
there's still so much uncertainty. Or is it just performance?
Well, I think in the UK it is specifically that there's just so much uncertainty, and that Brexit and its outcome is going to be such an influencer on the FTSE All-Share. You know, at the moment, the FTSE 100 have been a beneficiary of the concerns. Basically, that's weighed down on sterling, and that's been good for those top 100 companies. And you know, just as broad brushstrokes, it's been the domestic and smaller companies that have struggled. The market isn't pricing in no deal, so if no deal happens, then there is serious downside risk. But in the law of probability and the consensus, we're hoping for some kind of deal to take place, whatever form that might be, and then there is upside potential there. And it's sort of affecting, conversely, you know, those that have been unloved, domestic base, will probably be a little bit better off in that environment. Because that's such a binary event, it's very difficult to, and it's such a big influence on the fortunes of that market, it's very difficult to make a call. Europe is slightly easier because the monetary policy there, we know it's tightening, but it's still loose. We know that it hasn't fared very well when there's been concerns around how China manages its slowdown. So the key for Europe is how China manages its slowdown for us next year.
So that's kind of a regional outlook. Yeah. If we were looking at sectors, to be looking at over the next year, I mean, maybe break it down into smaller parts, you know, next quarter, next half, rather than across the whole year. What would you be looking at?
Well, I think the call on the sectors is at what point you want to rotate your portfolio into out of your kind of momentum growth stocks and into your more defensive companies that and sectors that are more geared up for a slowdown and ultimate recession. So that's a key call. Now,
but if you're saying we're seeing probably see some upside, potential upside to begin with before we get into that part of the cycle, is it then, you say the defensive doesn't come into it until near the end of the year, another 6 months?
Well, yeah, so if we take the geopolitical risks aside and we just look at monetary policy in the US and what's happening there and the likelihood of that moving us through the cycle, in a period where rates are still low and supportive, there is still an argument to be holding growth stocks, tech, for instance, and discretionary spend, those kind of areas that are more tied into the growth stage of the cycle. We think that there is still upside room for that area, actually. The decision that you really have to make across the portfolio is at what point do you start moving into those defensives? Now, that would be a move into consumer staples, into utilities, into property, sort of higher yielding, less cyclical companies, and maybe even financials if inflation is picking up. Now, that is just about the challenge of when you do it, and this is your time. You don't want to go too early. And so I think 2019 for us is about preparing for that eventuality, 2020, the expected kind of slowdown, and just looking for the signals in the market to say, are we there or are we not? And then start tilting the portfolio into that area. And
what signals would they be for you?
Well, we have the benefit of investing in funds. They're managed by some of the largest investors in the market. They are accessing different styles and approaches, and we are looking for those more defensive managers to actually start outperforming. That will be one of the triggers. If they start calling us, start looking happier when we speak to them, that will be one of our signals, but that's a bit of a trivial one. We'll also be looking at factors in the marketplace. So, what are going to be the triggers for slowdown? Well, it's going to be what the Fed does with rates. It'll be what happens to the yield curve and when it starts inverting. And there'll be other triggers where some vulnerable sectors like tech might start selling off. And so those will be some of the flags amongst others that we'll be looking at. Yeah,
I mean, some of the articles, they mentioned global liquidity now slowing, fastest rate since the 2008 crisis. Banks, share price sliding, obviously also a bad sign. You look at that. Lehman Brothers. First month since Lehman Brothers crashed, no junk bonds were sold. So there's a lot of things that people are already starting to point to as an indication that we are very close to the end of this run.
And I think, well, I mean, people have been pointing to the end of the run for the last 2 years. And so, things do move through a cycle. It is about getting your timing right. Timing is notoriously difficult to do. There are so many different factors at play. For us, the key is to focus on the fact that there are a number of geopolitical risks out there that could be resolved, and they could be resolved positively. And for that has kept a lid on equity market performance over the past sort of 8 months, 10 months, and we think that there is upside room for there. But that is likely to be the last hurrah, and that will be one of the things that we will start to unwind from there.
Just very quickly, will it become a stock-specific market? Will it become a sector-specific, regions, or what should people be thinking of?
Well, I think our expectation in the final stages of this this part of the cycle, it is likely to be sector-driven. I think there are always going to be winners and losers within any sector, and clearly on a stock-specific level, there is an opportunity to add real alpha if you get it right, but also go the other way. And we will be looking to our managers and the active management to actually deliver the goods on that. As we move through the cycle, the biggest decision is going to be on a sector level. If you're not in the right sector, it doesn't matter what stock you've got.
Okay. Leave it there, but thank you very much, Oliver Wallin there from Octopus Investments, on his outlook for the equity markets in 2019.